Welcome and thank you all for joining us today at this briefing session on the HAF and NAF financial model and financial returnable schedule. I'm Lisa Marigliano. I'm the Director of Major Programs at Housing Australia. To begin, I'd like to acknowledge the traditional custodians of the various lands on which we meet today. I'd also like to pay my respects to elders past, present and emerging, and extend that respect to other Aboriginal and Torres Strait Islander people present in this call today. This is the first of two technical briefings that we're running to help eligible applicants complete their response to the call for applications in this program, the Housing Australia Future Fund Facility and the National Housing Accord Facility. I'm joined today by Michael Palassis and Stefan Giannis from Paxson Group, who've been advising Housing Australia and have been instrumental in developing the pro forma financial model. They'll provide an outline and a demonstration of the pro forma financial model and returnable schedule. I'll just do a brief intro and then I'll hand over to Michael and Stefan to run through a demonstration. We'll be using today's session to take you through the model and talk you through its application. I know you may have some questions and I hope that these are answered by the information that you'll see today. I'd like to give Stefan as much time as possible in this hour and a half to provide the demonstration. So we're not proposing to have a Q&A session at the end, but you can submit comments using the Ask a Question icon in this Zoom call. But if you'd like your question answered, please do submit it through the Housing Australia portal through the Q&A facility. Another important thing to note is that we've recently updated the pro forma financial model to allow for additional functionality and to incorporate some feedback that we've received from the market so far. These changes include adjusting the timing of quarterly availability payments and debt servicing to align with the commercial framework and providing further clarification of the interest rate risk assistance offered by Housing Australia. There will be an updated version of the financial model which will be published in the Housing Australia portal shortly, together with an addendum to the CFA. That will be shortly after this briefing session. The old financial model will be removed and replaced with the new one. So once that occurs, we'll distribute an email notification to all the users who are registered in the portal. The demonstration that Stefan will do today will be on the new financial model. So to put today's session in context, this is a technical and instructional briefing for the benefit of eligible applicants and the people who will be completing the funding applications. We won't be covering broader program level information, eligibility criteria or funding parameters. You might be aware there are also various online resources available in the Housing Australia portal to assist you, including a walkthrough video and a guide for how to complete and lodge an application generally. So while Michael and Stefan will be taking you through the model in a lot of detail, I might just give you some background around the model and its use before I hand over to them. So what's the purpose of the model? The call for applications process asks applicants to bid back an availability payment, which is the payment you consider necessary to make your affordable or social housing project financially viable. The pro forma financial model is a tool to assist you to estimate the size of this availability payment, noting availability payments should be sized at the minimum level needed in order for a particular project to be viable. The completed financial model is to be submitted as part of your application. How does it work? At a very high level, the financial model requires you to input various details and assumptions around your project and your proposed debt and equity financing sources. Using this information, the model then estimates the availability payment to meet your debt and equity requirements. Do applicants have to use the model? Applicants are not required to use the pro forma financial model, and you can use your own model. But if you do choose to use your own model, please be aware of three things. Your model needs to be independently audited. If you don't complete the pro forma model, you will need to instead complete the pro forma financial returnable schedule, which is part of the package of documents. And Stefan will be giving an overview of that schedule as part of today's presentation. And thirdly, regardless of the model that you use, just to reinforce that the availability payments should be sized at the minimum level needed for your project to be financially viable. So I'll now hand over to Michael and then Stefan to talk you through the model in more detail. Thanks, Stefan.
Thanks very much, Lisa, and good afternoon, everyone. I will just be conducting an introductory position regarding the financial model and the financial returnables, and then Stefan will be conducting a detailed walkthrough of the financial model. What I'd like to do first is just give you an explanation of the two separate options that are available to applicants in submitting their application with respect to the financial elements. Returnable Schedule 2 is the financial evaluation, and it requires applicants to submit a financial model with their application. And there are two options in doing so. As Lisa mentioned, applicants can complete either the pro forma financial model, which Housing Australia has prepared on behalf of applicants as a tool to enable applicants to complete the necessary financial requirements associated with their application. Or secondly, in option B, as it is referred to here, provide your own financial model that is required to be independently audited in a certain format, and the format of that is included within the call for applications document. Importantly, that option B, that option B does include financial returnable schedules for applicants to include in addition to the audited financial model that applicants are required to prepare themselves. So we have two options available, and I will now go on to explain why we've created those options. Next slide, please. So why do we need a financial model more broadly? It's very common practice in procurement of housing projects, infrastructure projects, and projects that have similar application to those of which the call for applications is supporting, to provide a financial model or a spreadsheet of some form that documents the full build-up of the financial offer provided by the applicant. There's a number of reasons for doing this. Is to allow the procurer or government to make an assessment of the price that's been offered to ensure that there's not been any errors made by the applicant in the build-up of their price, to assess the risk of certain assumptions that maybe sit behind applications where those assumptions are aggressive or may not stand up to due diligence, to understand the comparative value for money and drivers between the offers that have been received, and just to provide additional transparency that may be required for adjustments that are commercially allowable under the contracting framework for those projects. As Lisa mentioned, availability payments are the primary form of funding, and those of you familiar with the call for applications will appreciate that. And a lot of you will also appreciate that availability payments are a complex form of subsidy when compared to other forms of subsidy, and the decision that government's made to use that form drives the need for certain requirements of the financial model. And so what the financial modelling process, whether option A or option B are undertaken, is to assist in deriving and optimising the availability payments, and as Lisa mentioned, to achieve the appropriate availability payments that can be provided under the application. The financial model does require detailed financial modelling to provide that interface with operating costs, debt metrics, and equity metrics. And that's why we're using a financial model in this instance. Next slide, please. So why was there a pro forma financial model developed in the instance, the option A that was referred to? So it is not common practice for organisations such as Housing Australia, when conducting these processes, to provide a pro forma financial model, and that was a deliberate decision made by the organisation. And that decision is based on a few factors. The first is that the nature of the call for applications process and the eligibility for funding under the call for applications means that applicants can come from very different places, very different types of organisations with different levels of sophistication, different levels of capacity. And there is a wide range of potential applicants. And therefore, Housing Australia was conscious to ensure that parties with less sophistication than others had the tools available to them, such that the complexity of bidding for something like an availability payment or a project such as those being tendered are able to be bid by organisations with relative ease and simplicity. And so the first key driver was to remove some of those barriers and provide simplicity around the application process and remove some of the complexity for the broad range of organisations being able to apply under the call for applications. Unusually, again, in this process, and really as a construct of the nature of Housing Australia as an organisation, applicants are aware that the application allows for applicants to apply for 3 financial forms of accommodation at once. The first being availability payments, the second concessional loans, and the third potentially senior debt through Housing Australia's pre-existing senior debt program. In order to apply for one or all of those three forms of financial accommodation, there are different needs for financial information in the evaluation or in the credit assessment of the application for debt instruments. So the process that is being run by Housing Australia concurrently is running an evaluation for an availability payment and concessional loan process, plus a credit assessment, if the applicant so desires, for a senior debt. The needs of those two processes, and ordinarily a senior debt application, requires a heavy need for financial information, and Housing Australia, as the lender, has specific requirements that it seeks if an applicant is applying for senior debt. And therefore, as another reason for the request for the financial model being included as part of the call for applications, is that applicants are able to use the financial model to provide the information necessary in a format that Housing Australia would assess through a credit assessment process of the financial elements of the project. The call for application process and documentation includes loan product statements associated with the debt instruments, and the financial model replicates the credit metrics associated with those loan product statements and credit metrics, and enables applicants to assess whether prima facie their application will comply with those metrics and has some basis for receiving a credit approval in the future. The other items that the financial model seeks to achieve is to ensure that the suite of funding products offered by Housing Australia are being applied correctly, and also calculate the availability payments in a way that aligns with Housing Australia's various funding products. So there's a whole reason for why this pro forma financial model has been provided, and on balance, it's provided as an optional element, but importantly, to provide transparency, capacity building, and ease of application for the market in what otherwise might be a relatively complex process. And as Lisa mentioned, the pro forma financial model is not mandatory, but it is available to applicants to use as a tool for calculating their availability payments and other elements of the financial accommodation available under the call for applications. Next slide, thank you. So applicants, as I mentioned, can use either their own financial model, or they can use the pro forma financial model. In the instance that applicants are preparing their own financial model, the call for applications clearly states some requirements for that financial model in terms of its technical characteristics, formatting, etc. In addition to the requirements of that financial model, there is what is called a financial returnable schedule that applicants must complete. This is even in the instance that applicants are providing their own financial model. And this is a form of information in Excel format that is needed by Housing Australia to assist in the evaluation of the applications that are received, notwithstanding the fact that the applicant has provided their own financial model. So it gives Housing Australia the necessary standard elements of information that are required to conduct the evaluation. The reason that this second option has been provided is that whilst every best endeavours, and as you'll see when Stefan goes through the pro forma financial model, has been made to try and allow for the certain circumstances that might arise for applicant structures, financing approaches, and other nuances, a template model such as the pro forma financial model cannot meet the needs of every applicant and all circumstances that may be contemplated. And so the intent of providing this option B, which we're referring to, that comes accompanied with the financial returnable schedule, is where the circumstances are not appropriate or people elect to not use the pro forma financial model, there is still a need to provide financial information, being an audited financial model accompanied with what is referred to as the financial returnable schedule. So I'd like now to hand over to Stefan, who is now going to conduct a walkthrough of both of the pro forma financial model and the financial returnable schedule in quite an elongated process, The intent of this walkthrough is to assist actual users of the model and financial returnable schedule of the intent behind each of the elements of the pro forma financial model, and to walk through the steps that would be applied in deriving the various outputs that the model is seeking to derive. So I'll now hand over to Stefan Giannis. Thank you.
Thank you, Michael. And good afternoon, everybody. Thank you for your time. My name's Stefan Giannis from Paxson Group. I, as Michael mentioned, will be spending some time today walking through both the pro forma financial model and the financial returnable schedule in detail. I've also included some sample projects to share. So starting with the pro forma financial model, this slide just outlines a high-level summary of the structure of the pro forma financial model itself. The model structure is relatively simple. It's separated into 4 key distinct parts, each identified by a different covered worksheet within the model itself. Again, I'll walk through each of these worksheets in more detail on the screen, but before I get to that, just in summary, going through the different structures of the model. The first is the global worksheets, which are identified by the black color. These worksheets are relatively high level and provide some summary information and context to the overall model itself. It includes the cover worksheet, which provides some important information regarding the purpose of the pro forma financial model, as well as some terms and conditions that are important for applicants to understand as well. The instructions worksheet provides a high-level overview of the model itself and some instructions as to how to use the model. And finally, the technical sheets are required for model mechanics and charting purposes, but not needed to be used by applicants for any inputs or the like. The yellow development input section of the model, the yellow sheets are really where the applicants will spend most of the time in the financial model. This is where they'll be required to input data, assumptions, and the like into the financial model. The applicant details sheet is relatively simple. This just asks for information regarding the applicant themselves and some details of the project itself. The project inputs worksheet is quite detailed, and it includes all of the operational assumptions and some other financing and the like assumptions required for the project. The development inputs tab is only relevant for a project which is assuming that it's delivered by the applicant themselves, as opposed to a takeout acquisition, which is where the applicant just acquires the completed building at practical completion of the development. The other inputs I'll walk through again on screen, but these aren't relevant for model calculations. The other inputs worksheet is a section where the applicants can input information regarding other concessional elements that might be contributed to the project from state or local governments. The third box, calculations. So this is really where the model does most of its work. After the applicants put in all of the inputs into those yellow tabs, the monthly calculations can have the underlying mechanics of the model, where it's calculating the operational and financing cash flows of the project for the 25-year horizon that this pro forma financial model is looking at. Finally, the blue outputs worksheets. These just provide summary information regarding the financial and other key metric outputs for both the applicant, but also for Housing Australia once they've got the financial model returned by the applicant. I'll move to the next slide. So as well as this video and the instructions that are contained within the pro forma financial model, we've also developed a financial model user guide, which is available for applicants to download through the portal. Applicants should be able to use this user guide to provide much more detailed guidance regarding all of the specific inputs in the model itself, as well as how to use the model. So you can see here there's a screenshot of one of the pages within the model guide, which says how to input some of the inputs, as well as to say, well, what are the steps to review the populated model? So it gives you a bit more guidance and help with filling the model out, but also using the model itself. So now getting to the main part of what I'd like to do today, which is to actually walk through the pro forma financial model on screen. I've prepared 2 very high-level sample projects just to talk through. I do want to emphasize that all of the assumptions that I'll be entering into these models today are just for illustrative purposes only. The inputs nor assumptions that I'll be using, they do not represent Housing Australia's views nor expectations, and applicants should be undertaking their own due diligence to inform any of the assumptions that they input into their own models. So please don't take any of the numbers that I will show on screen today as any guidance or anything like that from Housing Australia. So the first sample project I'll walk through will be a turnkey acquisition. Illustratively, I've assumed that it will be acquired on 30 June this year, 2024. It'll be a freehold tenure, so it'll be owned by the applicant. It's for 10 social dwellings, costing $500,000 per dwelling, and it will be an equity-like equity instrument that will be requiring a required equity return of 10% internal rate of return for their stake in the project. And I'll go through what those assumptions mean in a bit more detail as I'm inputting them into the pro forma financial model. The second sample project that I'll be talking through today is similar to the first, but in this case, it'll be, instead of a turnkey acquisition, it's a project which is delivered by the applicant, which means that it will also include the development phase. So it'll include the cost and financing elements of developing and building those 10 social dwellings. This one's a little bit different as well. Just illustratively, this sample project also benefits from a $1 million grant of land. So the land for this project is being contributed for free to this project by an external provider, which means assuming a $4 million development cost, it's going to be a little bit cheaper than buying those 10 social dwellings in sample project 1 for the $5 million. All else being equal, you'd expect this project therefore should require less availability payment to make it stack up financially. So I will now just close this and open up the pro forma financial model. And I will zoom in because I'm sure that's very small for a lot of the people's screens. But before I do that, this pro forma financial model, as I think Lisa mentioned already, does have some slight differences to the current version of the model that's up on the portal. This one will be uploaded shortly, but materially it's consistent with the previous version. So hopefully nothing too surprising for anyone that's already been working away at using it. As you can see, the worksheets along the bottom align to that structure diagram that I referred to earlier. So you can see some of the global tabs at the front cover the instructions and the text sheets at the end. The yellow tabs are where the inputs are required from the applicant. The grey tabs are the calculations, and then finally the blue tabs, which are the key output areas. So the version that I've opened up on screen now, you'll see is exactly the version that you'll be able to download from the portal. It's completely empty. So I've just jumped across to the output summary worksheet. And again, I'll zoom in on all of these worksheets as we go through. This is all blank. It's got none of the input assumptions relevant to the project, which the applicant will be required to input, with the exception of some pre-populated assumptions for if the applicant is requesting for Housing Australia debt, for example, through the ABBA facility, then the assumptions that applicants should use and are required to use are pre-populated in this financial model, which I'll go through in more detail shortly. So just a bit of a starting from the left to the right about how to use the model. As I mentioned, there's the cover worksheet already, which includes some interesting reading about the disclaimer for the model, the overall purpose of the model, and some general terms and conditions around using this model that the applicant should read before using it. The instructions worksheet itself is not really meant to be used instead of the model user guide that I mentioned, which can be referred to separately. This is a much more high-level instruction and guide about how to use the model and what's the purpose. For more detail, the applicant should be aware that there's that separate model user guide that I mentioned earlier. So I think starting with how to actually input data into the model, the first worksheet to start with is the applicant details worksheet. So as you go through, you'll notice that all of these yellow cells identify where the applicant is required to input assumptions or information. Everything else can't be touched, can't be edited, it's all locked. That's purposefully, that's done intentionally. The applicant should just focus on entering these things in here. So entering the organisation information such as the name, the trading name should all be done in here. There's some drop-down boxes where appropriate to select, for example, what organisation type is the applicant for this project. For now, I'm going to illustratively just pick the HAF SPV. Go down to the project name. Obviously, this doesn't affect the financial calculations of the model, but should be input by the applicant anyway. So I'll just go through this relatively quickly. Suburb can be enter in the state, for example. So I'll just choose Tasmania. The vendor name, so where a project is a turnkey and you're buying it from a developer or somebody else, then we should, the applicant should input who the vendor is so we can identify them. And finally, there's a remoteness classification as well, input required. So I think 705 is near Hobart. Let's choose a metro area. And that's it for the applicant details worksheet. So relatively straightforward. I'll move now onto the more detailed inputs, which will be provided on the project inputs worksheet now. So I'll zoom in a second, but before I do, I just wanted to call out these big blue boxes on the right. So as well as the user guide, there's also these more concise description and instructions sections which can be used by the applicant to inform the relevant section here. So there's, for each of these sections, some more materials that the applicant can use to help them when they're filling out the model. For now, I'm going to zoom in a bit more so that we don't need to get distracted by all that and just walk you through every single one of the inputs down this worksheet. So for this sample project, I mentioned it was a turnkey acquisition. The model does allow you to choose either a turnkey acquisition or the self-develop approach that I mentioned. Freehold or leasehold, applicants can quite easily here choose between whether it's a freehold ownership of the site itself or whether it's a leasehold. Under the leasehold model, the project will need to be handed back to whoever the actual landowner is at the end of the leasehold tenure, and you can input the term of that lease where relevant in the next cell, this yellow cell below. So that's it for the development approach. If I keep moving down here to the turnkey acquisition inputs, so there's some acquisition and acquisition cost inputs here that are required to be input by the applicant. So my sample project, I'll assume that we're acquiring the 10 social dwellings on the 30 June this year. Illustratively, I'll assume that the price for these dwellings is going to be $500,000 each. There's the ability in this model to input several different types of dwellings where they're different. So if there's a 1-bedroom, a 2-bedroom, 3-bedroom, you can identify the acquisition cost per each of those types of dwellings. You can also input a number of other potential acquisition cost types. So professional consultant fees, some contingency if it's not a fixed price and there's some risk involved, then it's important for the applicant to ensure there's appropriate contingency assumed in here. If there's some non-reclaimable GST, so obviously every project will be different. If some of the GST, for whatever reason, cannot be reclaimed, that should be costed to the project as well and input here. For the purpose of my illustrative sample project, I'm going to leave these blank and assume that the total cost is going to be 10 units of 500,000, which is $5 million. There's a section here for some other eligible resources which are contributed to the project. This will be outlined a bit more in the model user guide and other materials on the app. I'm going to assume that there's nothing being contributed for this sample project one. Moving on to the applied developments input section here. So you'll see most of these cells are white or grey. Again, focus on the yellow cells. The white and grey are summaries and of information which is being input elsewhere or calculated elsewhere into the model. There is one yellow cell here which is important to input. This is the project's unimpaired fair value on completion. This cell is important because it helps to determine both the debt sizing as well as the residual terminal value that's available to equity or the charitable entity at the end of the 25-year project horizon that we're looking at. So just again, illustratively, I'm going to assume that the project's fair value is what it costs to acquire in this case, which is the $5 million. Again, that's the unimpaired value. So that's assuming there's no restrictions on the use of the asset after the 25-year period for social or affordable purposes, for example. Moving now down to the operational inputs. So there's a section here where you can input in your escalation assumptions. So the escalation modeling allows you to input different escalation assumptions for the different types of revenue and costs and asset valuation within the model. It also allows you to input individual annual escalations for the first 5 years, and then there's tranches of 5-yearly escalations after that point. So you can be a little bit more precise with your earlier year escalation. Year 1 is blank. That's intentional. All of the inputs within this model should be input as the nominal dollar for the first year of operations. So later on when I get to rent, if there's $300 of rent, that means you're expecting to receive $300 per week for that dwelling in the first year of operations. This escalation will then be applied to every year thereafter. So for example, I'm just going to assume everything escalates at 3%, relatively high inflationary environment for the next 4 years, or 4 years after the operational commencement. After that, I'm just going to assume that it reverts back to the midpoint of the RBA target range. Obviously, these assumptions should be due diligenced and based on what the applicant expects for their project. That's escalation. Moving on to residential inputs. So as I mentioned, this project has 10 dwellings. I'm just going to assume that they're all 2-bedroom social dwellings. The applicant can obviously put quite a lot of detail into here and have different dwelling types and categories, 1, 2, 3 bedrooms, or input your own types. Identify whether they're social, affordable, market, or other, and that should all flow through to the model correctly. There's different inputs for rent and OPEX for each of these types of dwellings. So moving down, again, illustrative numbers, I'm going to assume that the 2-bedroom, each two-bedroom social dwelling here receives $300 per week. This is excluding Commonwealth rental assistance, which you'll see is a separate input below. It is important as well for applicants to also include the assumed corresponding market rent when they're inputting this. So I'm just going to use 1,000 round number. So that would be if the dwelling was not operated as social, then what would the market rent be implied for that dwelling? That's important because it helps us to align to Housing Australia's amortization policy under the ABBA loan product guidelines, which are outlined in summary here, but also more detail that you can download on the HAP portal as well. But basically where those dwellings are not constrained to be operated as social at the end of the 25 years, then at least for amortization purposes, we can calculate the cash flows in year 26, assuming that they can, if required, be reverted to market. Commonwealth rental assistance. So again, I'm just going to use round numbers. Social, I'm going to assume that there's another $50 of CRA per week per each of those social dwellings. Nothing, obviously, for the market dwellings. Moving down now to the other residential inputs. So here is where you can input a bad debt and vacancy percentage. Again, I'm just going to, for the purpose of this, be relatively simple and just assume that they're 1% each. Moving on to operating costs. So this is where you can input in tenancy and property management costs, as well as maintenance and life cycle costs into the model. So we've separated them out differently. For tenancy and property management, so this is all of the operating costs in the model. I'm just going to assume for a social dwelling, it's 10,000. Note that where there's any non-recoverable GST, that should be included in here as well. So for my model, I'm going to assume that there's an extra 10% of OPEX for the market dwellings because there's some GST that can't be recovered. Next, you can input in your life cycle periods and costings. So for the purpose of this model, I'm just going to assume that for the first 10 years, there is no life cycle reserving required. It's a new build. But then thereafter, from years 11 onwards, I'm going to need to spend $1,000 for the social, and again, 1,000 plus GST for the market. Again, indicative numbers, obviously the applicants should use their own assumptions for their projects where relevant. Non-residential inputs. So this area you can relatively simply input in some additional rent or revenues that might be received in the project. So this includes NLA square meters of any non-residential area for the site. So if there's commercial space or retail, then that can be inserted here, and a net revenue figure. So that's revenue less any costs associated with the non-residential space as well. My project's just 10 dwellings, so I'm not going to include any of that. Similarly, if there's any other revenues or costs, they can be the other revenues can be input here with the base year and then its own bespoke annual escalation thereafter. Leasehold costs. So if you recall the land tenure at the start, there was an input for a potential leasehold structure. In that case, if there is a lease that's payable to the landowner in that case, then that can be input here as well. So that's it for the operational inputs. The next section we get to is regarding the HAF and the NAF availability payment inputs. So by default, the model will solve for the minimum availability payment that's required to meet both the debt and equity parameters and metrics. That's switched on here to yes, we intend this financial model to solve for that outcome. Where applicants want to input their own number, they are able to override the estimate by clicking no here. So for now, I'm going to leave that as yes to have the model generate it itself, which means you don't need to input an override figure here. Moving now on to the financing inputs. So as I mentioned, the model will solve for the minimum availability payment that's required to meet both debt and equity parameters. So it means that it will optimize for the capital structure depending on the inputs, which we'll get to shortly. The model does allow applicants to override the optimized mix if they so require, or if they've got other reasons that this model doesn't cater for. So you can override the capital stack here. Moving on to the concessional loan section. So those familiar with the financing products available under the HAF will know that there's a concessional loan potentially available for eligible participants. Here, there's an input for the applicant to identify whether they wish to apply for the concessional loan. So yes, I will look to apply for that. Is the applicant eligible for concessional loan for up to 30% of the project costs? Again, there's more guidance provided in the portal and in the instructions here. I'm going to select no, I'm not available for that, and I'm going to apply for the full 10% that I'm eligible for here. So I'll leave that as is. Moving on to the next input, again, it's the yellow cells that I'm looking at. Other external upfront grant funding. Is there some other grant funding that's being provided by some external party to support this project? I can put that in here. For this sample project, no, we don't have any other external grant that's being provided. Moving on now to the senior debt inputs. So as I mentioned, there's the default approach for this financial model is to assume that it will be utilising Housing Australia's ABBA facilities. You don't have to request ABBA facilities. You can switch this toggle to a commercial bank, for example, if that's the applicant's intention. Where you do use the ABBA loan as the source of senior debt being requested, then all of these assumptions around debt sizing, timing and tenor and rates are provided, pre-populated in the financial model, and the applicant should not, or doesn't need to and should not change them because everyone will be evaluated on the same set of Housing Australia assumptions. Where the applicant does decide to use non-ABBA financing, for example, a commercial bank, then all of these inputs will need to be input by the applicant as appropriate and relevant for the type of financing that they're requesting. So that includes the debt sizing parameters that I've got here, as well as moving down the timing and tenor. So if it's a much shorter period of loan that the applicant is expecting to get from the commercial lender, then that can be input here as, like a three-year facility, for example. Same point for the refinancing base rates and the margins that should be assumed for the commercial lender. They can be input into these yellow cells. Again, to reiterate, where ABBA financing is requested, these are all pre-populated and this section does not need to be touched. One area that the applicant does need to consider, even when exploring ABBA, or only when exploring requesting ABBA facility, is whether they elect to opt in to the interest rate management product that's being offered by Housing Australia. Again, that product itself is covered in more detail elsewhere, but from a modelling perspective, I'm going to say yes, I do want to lock in my interest rates. And I'm going to assume that the contract close date for the availability payment is the end of March this year. So there'll be the 4-month period before the financial close occurs. Moving down, there's some other assumptions: established upfront fees and refinancing fees, amortization target. So you can override the residual debt balance target even under the ABBA facility here. By default, it applies the amortization methodology as outlined in the ABBA loan product guideline. But if, for example, you wanted to be more conservative, then you could, for example, override this and say, actually, we want by the end of year 25 to have no debt outstanding. You could override this with 0, and that would flow through accordingly into the financial model. Naturally, if you're requiring to fully amortize the debt over that period, I'd expect that a higher availability payment would be required to solve that. So factor that into your consideration as well. Moving on now to the equity or the equity-like financing elements. So this financial model allows for 3 types of equity instruments, and I'll walk through each one. So equity-like is like equity. It allows, at least for modelling purposes, for all the residual income each year to be distributed out to that equity-like instrument after senior debt servicing and servicing the costs and requirements of the project. At the end of the 25-year investment horizon, this instrument also fully values the residual value of the project at that point in time for the equity-like investor. Moving on to the mezzanine finance. So this instrument behaves much more like a subordinated debt financing element, and it requires a fixed coupon to be paid each period out of the project cash flows. This mezzanine finance facility also assumes that it's just a par value for return of its face value at the end of the 25 years, so it doesn't share in any equity residual value of the project or any upside in the capital growth of the project. The mezzanine finance therefore does also have some residual cash flows in subsequent operating periods which aren't required to service the fixed coupon for the mezz finance. So there are some surplus cash flows under this structure, which this model assumes gets received by the charitable entity, who's assumed to be part of the project as well. Finally, the capital note. So the capital note behaves like the equity-like instrument during the 25-year operational period. So it will receive all of the surplus residual income after senior debt servicing for the operational period. But then at the end of the 25 years, again, like mezz finance, it just receives the par value of the instrument. So if they put in $5 million on in the capital structure at day 1, they'll just get $5 million back at the end of the 25 years. And like mezz finance, any of that surplus equity value, or I shouldn't say equity, but the surplus value at the end of the project is assumed to go to the charitable entity. So for my sample project, I'm going to select equity-like. Moving down to the next section, this outlines what's the required equity return for whatever the equity investor type is. I use equity-like, again, round numbers. I'm going to assume that they require a 10% return for their contribution to the project. The total equity capacity here, is there a limit to the amount of equity that the investor has? For now, I'm just going to leave this no, but in the case that there is like a cash constraint, which is often the case for the investor, then this can be flagged here as yes, and input into this yellow cell below. Charitable entity benefits. This section doesn't go to calculating the availability payment sizing, but is still useful for Housing Australia's understanding to say, well, is there a charitable entity involved in this project, and how so? This input here allows the applicant to identify whether it is a charitable entity that's providing any of the aforementioned equity instrument or equity-like instrument above. So just for now, I'll assume that there's $1 million being provided by the charitable entity. I'll come back to these rows later as we get through to the development approach. In here as well, this is the last input on the worksheet. There's a text field input for applicants to identify whether there's any other charitable other benefits applied or received by the charitable entity under this arrangement. So this, for example, might be some allocation to upside returns or income that aren't considered elsewhere in the project. Again, there's some more guidance and information around what this actually means, both here in the model to the right, but also in the model user guide. For now, I'm just going to leave that blank. So that's all of my inputs for the project inputs worksheet. Basically everything I need to run this sample project. So I think once you get used to using the model, we probably could have input all of those inputs in less than 5 minutes. The next step is I would recommend is to review all of the inputs that we just went through. I won't do that on the call for the interest of time, but I would do that first. The development inputs worksheet isn't needed for this turnkey acquisition delivery model that we're talking about. I'll come back to this in sample project 2. The other inputs tab, I'll zoom in a little bit here, is similar to what I mentioned before about the charitable entity benefit text input. This is similarly a text input that is not used in the calculation of the availability payment or any of the modeled cash flows, but this section is for applicants to input whether there's any concessional contributions to the project from a state or local government, for example. So finally, moving to the output summary worksheet. So this is probably the key summary worksheet of this financial model, and this will identify some key information extracts of the financial model. So top left square rectangle identifies the applicant information and project and a bit of an overview about the project itself that we've filled in some of the other tabs. Equity returns and credit metrics over here show you your financing metrics. So you can see here, if you recall, we input a equity-like target IRR of 10%. You can see here the model's already calculated an availability payment that would actually solve this equity investor's return without any debt sizing, which is what I'll get to in the next, which is what the macro does, and I'll get to that shortly. So this shows a pretty inefficient capital structure, but I'll get to that shortly and show you how by using debt we can improve the financial viability of the project. There's a project typology overview at the top. So if you recall, this sample project has 10 social dwellings, all 2-bedroom units, the charitable entity return summary, and then some key charts that give some key information about the project itself, about credit metrics, the DSCR, the amount of debt outstanding over time, income yield to equity investors, and cumulative cash flows to equity, including the terminal value assumption there. Finally, some sections on the right show you the capital stack for the development stage, which again is not used in this sample project, but will be in the next. The capital stack for the takeout phase. So as I mentioned, before I've run the gearing macro, it's assuming that it's 90% equity funded and you've got the 10% concessional loan there. So once applicants have input all the relevant information in, I would recommend saving it, coming back to this model, this worksheet, sorry, and clicking the gearing macro. The only thing that the gearing macro does is solve a couple of the minor circularities within the model. So there's the debt service reserve account calculation, as well as when there's a development stage, some circularity in the financing costs during the development stage. So this will solve that. It will also try to optimize the amount of gearing that this project should have to minimize the amount of availability payments required to deliver the required returns for both equity and debt that I mentioned before. So clicking this button does that. It shouldn't take too long. It should be usually about 30 seconds or less, but we'll wait to see what it comes out with this time. So macro solved, the little box in the middle just came up, popped up, click OK, and then all these charts should refresh. You can see now, if I jump to the top left, in row 2, there's a bit of an output of a summary of the project. So this is saying, happy days, it's all solved correctly. You can see down here at the bottom that there's an availability payment Again, it's just illustrative numbers of about $14,000 per social and affordable dwelling. You can see here, importantly, that it's been optimized because it's solved for both the target return for the equity investors as well as the credit metrics for the Housing Australia debt that we've requested here. So it's sized it to a 1.20 times target debt service coverage ratio, which you can see improves over time due to escalation of the cash flows for the project. But as a minimum point, it's debt sized to that 1.20 minimum, but it's also optimized this by delivering the 10% return to equity. So that results in what the model is indicating as the optimized capital structure for the project. Just in the interest of time, I might keep moving a bit faster through some of the other, probably the other sample project that I wanted to talk to. So the next sample project that I wanted to show, if you recall from the slide that I showed earlier, was the same project, but being delivered by the applicant. So in that case, the applicant should go over to the project inputs tab. And if you recall, there was an input here, which identified whether it was a turnkey acquisition or a self-develop approach. So now I'm going to change to self-develop. What this is going to do is grey out this turnkey acquisition area here. So these inputs are no longer relevant because we've moved from a turnkey acquisition model to a self-delivery model. So what we now need to do is go to the development inputs tab. And again, I'll zoom in, make it a bit more user-friendly, and input all of the yellow cells in this worksheet. So I'm going to just assume that none of this really changes, but maybe there's a 12-month construction phase for building the 10 dwellings. So this section here, section 1, just requests the timing inputs. So starting from 1 January 2024, the design and the planning is assumed for my project to commence, expected to finish by the end of this calendar year, after which time construction will commence and last for 12 months before the project is assumed to be completely built and ready for operation by 31st of December 2025. So what matters here is when construction commences, because that is when all the development costs that we'll identify below are assumed to start being incurred. That will drive a calculation within the model for financing costs. This model assumes that it's a straight line spend profile over the 12-month period, and that debt will be provided last. And it does provide an estimate, therefore, of the financing costs that you'll need to incur on the debt financing during that time. I'll go through shortly an area where applicants can override that if they've got their own separate calculation, for example, a more detailed expenditure S-curve profile and more precise calculations of financing. This model can override that. Moving to the development cost inputs. So there's a summary at the top, but what is most relevant for applicants as they're going through, again, are all these yellow input cells. So there's been a number of common cost items that have been pre-populated in these yellow cells in column B. Applicants will need to input the actual costs for those items, as well as any other costs that aren't pre-populated here, which is why there's been some cells with spares included so that the applicants can put in their own cost breakdown, as long as it's all inclusive within this spreadsheet. So I'm not going to input any of these costs for now under land acquisition for my project. If you recall, my sample project did have a land contribution of $1 million being granted to the project and not costed. So I might spend a minute just walking through what this section means. For my sample project, I mentioned the fair value of the land was $1 million. I'll input that there. Is the land being contributed as equity to the project and requiring a return? Again, there are a few inputs throughout this model which are probably not going to be used by the majority of projects. They're there in case they are needed to be used to try to give a bit more flexibility and make this project more useful and able to be used for more projects. This assumption could be the case where, for example, a community housing provider owns some land and their contribution to the project is providing that land. So in this case, if they've got land that's worth $1 million, that's their equity contribution to the project. Yes. Is the contribution being made by the charitable entity? Yes. If this is the case as well, you should be entering in what is the contribution of the land that's actually being costed to the project as equity. In that case that I just talked through, the CHP may say, well, I'm going to allocate the whole fair value of that land as equity to the project. So by doing this layout, it's got a real cost of $1 million that's allocated to the project, and there is an equity return that's required to be earned or received in respect of that equity contribution to the project. For my sample project, it's not being provided by a charitable entity. It's being provided by an external third party, and therefore it's not being costed to the project. So if there was a hard land acquisition cost, then it should be input there. So an extra zero. You'd have to buy the land from whomever the current owner is, but in my case, it's not. So a lot of different categories here, and I'll quickly just touch on some of these so that the users are aware that they're there. Site remediation costs such as decontamination, if there's a cost associated with that, then please input it here. Site preparation, infrastructure charges, for example, can be input here. If there's any other transaction costs like SPV establishments, that can be input here. The upfront financing fees, shaded white, and a little bit just to differentiate them from the other inputs. And you can see here there's an override here for a reason. That's because, again, that cost might be circular, and therefore this model does calculate it. There's 3 costs like this. There's the upfront financing fees, there's interest charged during financing, and there's some line fees or commitment fees able to be input into the model. The model will calculate these based on the inputs, or you can override them, as I mentioned. So for now, I'm not going to override it because I'll let the model calculate it itself. Next category is professional consultant and statutory fees. So again, there's some pre-populated items there for applicants to input where required and relevant. Finally, construction costs. So this is probably where some of the key costs are going to be. Demolition, main contract sum. For my project, I'm going to assume that the main project sum is going to be $2.5 million. Again, just illustrative numbers. I do want to pause a little bit on contingencies because I think it's important to highlight that there is an expectation that where appropriate, the applicant will identify and input the appropriate contingencies. So, for example, if there's a project which is a bit more hypothetical and it hasn't got any finalized designs, it hasn't got a DA approved, hasn't got a fixed building price with a builder, then it's appropriate for the applicant to consider an appropriate contingency to apply in that case. So for now, illustratively, I'm just going to assume that there's $500,000 of each of those contingency elements applied to my project. So you can see now that there's the total cost of the project to develop of $4 million, noting that there's $1 million of free land. Moving through escalation. So this is where you'd put in, it's great that we've got all those costs above, but is there, if it's a year out, is there going to be escalation before these costs actually get incurred? And that needs to be factored in as well. There's the financing cost during construction that I mentioned are calculated by the model, but also able to be overridden if required. And then some couple of other sections, including some statutory costs where required, some non-reclaimable GST. So my project's 10 Social. I'm assuming it's a charitable entity, and therefore that it is potentially eligible for a GST, for not paying GST on this project. All of the other projects are input as ex GST. If there is an element of non-reclaimable GST, then this can be input here as well. And then finally, just a catch-all for any other costs that might be required as well. Okay, so that's gone through the development costing inputs. I might just actually jump right to the top, back to the summary that I mentioned before. So you can see here, this is just a nice tidy little summary of the construction costs that I walked through. There's a $4 million of costs that I input, and then there's also some calculated financing charges as well, which I'm getting to now. So getting to the next section, just going down to the development finance inputs. So this row here just allows the applicant to identify whether it's the same financing structure at the end of the development as it is at the start. So under this one, if you recall, this structure, it's a self-developed structure. So if it's the same equity, same debt, same concessional loan piece, which is what the default assumption of this model is, applicants can select yes here. If it's not, you can select no, and you can override the capital stack with whatever the applicant is actually financing the project with. In my case, yes, it's the same capital structure, so I'm going to select yes, and therefore all these numbers will be pulled through from the takeout financing calculation that's done throughout the model. Other external grant funding, again, if there's some separate external grant funding from a third party, this can be different to some other third-party external grant that might be funded on takeout. This is, hey, is there any grant funding being provided during the development? That can be input here as well, and then that will form part of the capital stack. Interest and fees during construction. So similar to what I walked through in the other project inputs section, where the desired source of development financing here is Housing Australia, and it's got some pre-populated assumptions which the applicant should not change. To the extent that the applicant intends to use commercial bank financing for the development stage as separate to the operating phase, or not using Housing Australia, then that also can be done here. And again, similar to the other process, we'll need to input in the appropriate costing and other assumptions for that facility. And that's it. So that's it for the development inputs worksheet. Because we've already input all of the operating assumptions already in the project inputs worksheet, we don't need to go back and redo that. So now all we need to do is go back to the output summary tab. See that button. Click the gearing macro button again. And presuming I've input all the data correctly, which I should have checked before I clicked the macro button, then it will recalculate the required the optimized gearing structure to try to minimize the availability payment required to meet the equity requirements and debt credit covenants of this project. So what should be happening is this actual equity IRR here that you can see at the bottom left of my screen should be getting close to 10%, and the DSCR should be getting close to the 1.20, which is the minimum. If it all works as intended, then it'll pop up with that little box which says macro solved. And after that, applicants should always check the model to make sure all the inputs are right and all the outputs are logical and make sense, and then save it. So there you go, macro solved. Happy days. Again, it's optimized the availability payment. In this case, we only need 9,000. This is because, as I mentioned, we're getting $1 million of land being granted for free to this project. So it's a little bit better than spending the $5 million on the acquisition, where it delivers the same operating outcome post-development. Moving on to my next point. I think that's it then from the pro forma financial model. That hopefully gives some guidance as to how to use the model itself. Where I wanted to get to next was to go back to the PowerPoint and just talk about the financial returnable schedule. So the financial returnable schedule, I think it's already been discussed by both Michael and Lisa, is able to be used by applicants where they don't want to use the pro forma financial model, or where the pro forma financial model is not appropriate for their specific type of project, or the way that they look at evaluating projects and sizing availability payments, for example. So you'll see here, back in this PowerPoint, which I'll just maximize, the structure of the financial returnable schedule is very similar to the pro forma financial model, but it's been condensed. So it doesn't have, importantly, the calculation spreadsheets, which should not be shown on this slide. So what you'll see when I go to the financial returnable schedule, and this one I've pre-populated just in the interest of time, you'll see it doesn't have any of those calculation worksheets along the bottom, nor some of the other back-end technical outputs. It is consistently color-coded with the pro forma financial model. So again, all of these yellow, I'll zoom in a bit more, all of these yellow cells are really where applicants should focus their time and make sure that they input data correctly. So I might just walk through again, left to right. Cover sheet just gives a little bit of instructions to the applicant about how to use this returnable schedule. The preference is that this returnable schedule will be embedded and linked up with embedded within the applicant's own financial model, and then linked up appropriately, and then submitted with the financial model that the applicant submits. That it, again, being independently audited as well. So the development inputs tab, I'm not going to spend a lot of time going through this. It is exactly the same for the first section as the worksheet that I just walked through in the Performable Financial Model. And again, as I mentioned, I've pre-populated this with the exact same assumptions that I just walked through, so I won't bore you with that. Moving down to the development financing section, which has changed a little bit. So as I mentioned, this returnable schedule doesn't calculate much. It requires the applicant to do all their own calculations and solving in their own financial model, and then input the output of that model into this returnable schedule or link it up. So you can see here, this is the same project that I just walked through, the $4 million total development cost. This is the funding mix that was generated from the Performable Financial Model for this sample project. It's provided $2.5 million of senior debt, $1 million of equity, and the 10% of the concessional loan being $500,000. So that needed to be input here. It's not, again, it's not a calculation. That's it for that development inputs worksheet. Moving on now to the inputs sheet. I'll zoom in here. Again, broken record, but it is very similar structurally and format-wise with the Performable Financial Model. So nothing here is significantly different. As I walk through here, you can see, we're doing a self-developed project. It's a freehold land tenure. We're not using the turnkey acquisition inputs because it's a self-developed project, sample project. I've applied the same escalation inputs here. Important to note, obviously, given that this returnable schedule doesn't have any calculations to it, these are inputs only used by Housing Australia to understand the assumptions. These don't drive the calculations. So applicants will need to have their own model, which calculates all these assumptions. This is more of just an output of the applicant's assumptions rather than driving calculations. Same for all these assumption inputs. Moving down now to the financing inputs. Similarly to what I spoke about on the development inputs, the funding mix here for the practical completion stage of this self-developed project will need to be input in here by the applicant. Senior debt inputs, again, will just need to be input in here, all taken from the applicant's own financial model. So nothing really to call out here. This area is a little bit different. Because there's no calculations, there are some additional inputs required to be input in here. So for reference, this section helps the applicant understand how the amortization target needs to be calculated. It's got some amortization inputs here, which are required to be calculated within the applicant's own financial model, then input here to help Housing Australia evaluate the applicant's submission. I think that's it for there. Some equity inputs here, just for the applicant to input some text descriptions of the equity structure, just to give Housing Australia a little bit more information around how the applicant is approaching their own financial modelling. So moving now, just in closing, really, to the output summary. So again, very similar output spreadsheet to what you would have seen in the Performable Financial Model, with the addition of some elements that need to be input by the applicant in here. So the last area where there's some inputs required by the applicant, and probably the most significant, is the monthly financials tab. So this worksheet requires the applicant to input these in, again, from their own, as calculated from their own financial model, the monthly cash flow waterfall. Understand that not all applicants are going to have a monthly cash flow forecast or a monthly model developed. We're okay to receive a conversion from a quarterly or an annual model to be input into this monthly financial sheet as the applicants see most appropriate. But the inputs do need to be in monthly phases. So this will include a full detailed monthly cash flow waterfall. The next section is some calculation of some senior debt credit metrics. So the only input that's required here, which is not taken from the monthly cash flows, is an escalated security value for the project, which helps calculate the maximum gearing over the project life. Moving down now to the charitable entity benefits. So again, there's some information here about how to calculate this and what it means. But we are requiring applicants to input that data in here. Again, if it helps, you can always reference the pro forma financial model to get a better understanding of what this means and how it should be calculated. Finally, at the bottom, there's a very high level extract of both an income statement as well as a balance sheet. The remaining worksheets, the annual financials and the technical outputs worksheets, don't need to be used by the applicant. They are just outputs which will be generated by the inputs in the other worksheets. So that's the end of my presentation. Thank you all for your time today, and hopefully that helps provide some guidance as to how to use both the pro forma financial model and the returnable schedule. Thank you.
Well, thank you so much for running through that, and thank you everybody for dialing in today. I hope it was informative. We did receive a number of queries through the Q&A facility. Those that are relevant, we will publish some FAQs to clarify the responses to those points. And just a reminder that an addendum to the call for applications, together with the updated financial model, will be available in the portal shortly, as well as a recording of this session so you can watch the video back. Thank you so much.